Ratio calculation and analysis. Ratio calculation and analysis is like using math to understand how well a company is doing financially. We compare different numbers to get a clearer picture of its health, just like how you might use ratios to see if your savings are growing faster than your spending. Businesses use ratios to see if they are making enough profit, handling their debts well, and keeping enough cash for emergencies. Example: a company calculates its debt to equity ratio, which is the total amount of debt it owes divided by the money invested by its owners. If the ratio is zero point 0.5, it means the company has half as much debt as the money invested by its owners. Industry comparisons slash benchmarking. Industry comparisons are like comparing your performance in a game with other players to see how you're doing. Businesses do the same thing, but instead of a game, they compare their financial numbers with other companies in the same industry. This helps them understand if they are doing better or worse than their competitors. Example: a new tech company wants to see how well it's doing compared to other tech companies in terms of sales growth. They find that their sales growth is 15% while the industry average is 10%. This means they are performing better than most of their competitors. Profitability ratios slash margins. Profitability ratios show how much profit a company is making compared to its sales or expenses. It's like checking how much money you are making after paying for your toys or games. Example: a company's profit margin is 20%, which means for every $100 it makes in sales, $20 is left as profit after covering all expenses. A high profit margin indicates the company is managing costs well and making good profits. Return on assets. Return on assets, ROA, is like calculating how much money you made from the things you own. It shows how efficient a company is at using its buildings, machines, and money to generate profits. Example: a company's ROA is 10%, meaning it makes a profit of 10 cents for every dollar of assets it owns. If it has $1,000 in assets, it would be making $100 in profit. Liquidity ratios. Liquidity ratios are like checking if you have enough money in your piggy bank to buy that cool new gadget you want. Businesses use liquidity ratios to see if they have enough cash or easily sellable assets to handle their immediate expenses. Example: a company's current ratio is 2.5, indicating that it has $2.50 of current assets, like cash and inventory, for every $1 of current liabilities, like short-term debts and bills. A high current ratio suggests the company can easily pay its short-term obligations. Debt management ratios. Debt management ratios show how much debt a company has and how well it can handle it. It's like checking if you can easily pay off the money you've borrowed for your new bike. Example: a company's debt to equity ratio is zero point 0.8, meaning it has $0.80 of debt for every $1 of owner's equity. A lower ratio is usually better, as it shows the company is less reliant on borrowed money. Why are they important? Understanding these concepts and ratios is essential because decision making. Ratios help companies and investors make informed decisions about where to invest money, which companies are financially strong, and which ones need improvements. Identifying strengths and weaknesses. Ratios reveal a company's strengths and weaknesses, allowing them to focus on areas that need improvement and capitalize on their strengths. Comparing performance. Industry comparisons and benchmarks help companies gauge how they are doing compared to their competitors. It helps them set goals and improve their performance. Financial health. These ratios provide insights into a company's financial health, indicating if it's a safe investment or if there are risks associated with it. Business growth. By analyzing ratios like ROE, ROA, and profitability, companies can see how efficiently they are using their resources to grow and make money. Overall, ratio calculation and analysis are crucial tools for understanding a company's financial health, making smart business decisions, and setting a course for growth and success. Ratio calculation and analysis. Ratio calculation and analysis involves using mathematical tools to understand how well a company is performing financially. It's like checking different parts of a car to see if it's running smoothly. Ratios help us compare and understand the relationships between different numbers in a company's financial statements, like profit, expenses, and debts. Example: the current ratio is a simple ratio that tells us if a company has enough short term assets, like cash and inventory, to cover its short term liabilities, like bills and debts. If a company has a current ratio of 2, it means it has $2 in assets for every dollar it owes in liabilities. Market value ratios. Market value. Ratios help us understand how much investors think a company is worth in the stock market. It's like knowing how much people are willing to pay for a cool video game because they believe it's valuable. Example: the price to earnings, P/E, ratio is a popular market value ratio. If a company has a P/E ratio of 20, it means investors are willing to pay $20 for every dollar of the company's earnings, profits. A higher P/E ratio suggests investors have high expectations for the company's future. DuPont equation/ROE. The DuPont equation helps us understand what factors contribute to a company's return on equity, ROE. ROE shows us how well a company is using the money invested by its owners to make profits. It's like seeing how much profit you can make with the money you invested in a business. Example: the DuPont equation breaks down ROE into three parts: profit margin, how much profit a company makes from its sales; asset turnover, how efficiently a company uses its assets to generate sales; and financial leverage, how much debt a company uses to finance its operations. Understanding these factors helps a company improve its ROE by focusing on specific areas. Dividends. Dividends are like rewards that companies give to their shareholders. It's like sharing the profit cake with the people who own a piece of the company. Investors receive dividends as a return on their investment. Example: let's say you own 100 shares of a company's stock, and the company pays a dividend of $1 per share. You would receive $100 as a dividend. Companies that pay dividends often attract investors looking for a steady income from their investments. ROE, and growth. ROE, return on equity, and ROA, return on assets, are essential measures of a company's financial performance. ROE focuses on how well a company generates profit from the money invested by its owners, while ROA shows how efficiently a company uses its assets to generate profits. Example: if a company has an ROE of 15%, it means it's making a 15% return on the money invested by its shareholders. On the other hand, if its ROA is 10%, it means the company is making a 10% return on the assets it owns, like buildings and equipment. Why are they important? Understanding these concepts and ratios is crucial because financial health. Ratio analysis helps us assess a company's financial health and performance. It gives us a better understanding of its strengths and weaknesses. Investment decisions. Investors use these ratios to make informed decisions about which companies to invest in and how much they are willing to pay for their stocks. Company management. Companies use these ratios to evaluate their own performance and identify areas for improvement. It guides them in making strategic decisions. Business growth. ROA, and growth ratios help companies understand how well they are using their resources and if they are growing at a sustainable pace. Shareholder value. Dividends play a significant role in attracting and retaining investors. Regular dividend payments can make a company more attractive to potential shareholders. Overall, ratio analysis and the concepts of market value, ROE, ROA, and dividends are fundamental tools for investors, company management, and anyone interested in understanding the financial health and performance of a business. They help us make informed decisions and ensure the success and stability of companies in the long run. Profitability ratios. Profitability ratios help us understand how well a company is making money from the things it owns and spends. It's like checking how much profit you make from selling lemonade after you pay for the lemons and cups. These ratios show if the company is doing a good job at turning its investments into profits. Example: let's say Company A and Company B are both in the same business of selling toys. Company A has a higher profitability ratio, which means it's better at making profits from its toys compared to company B. This might attract more investors to company A, as they can see it's doing well financially. Liquidity ratios. Liquidity ratios help us understand if a company has enough cash to handle its financial responsibilities. It's like checking if you have enough money in your piggy bank to buy a new video game without borrowing money. These ratios show if the company can quickly pay its debts when they are due. Example, let's say Company X and Company Y have similar businesses, but Company X has a higher liquidity ratio. This means Company X has more cash on hand or easily sellable assets, giving it an advantage if they need to pay off sudden debts or bills. Debt ratios. Debt ratios tell us how much debt a company has compared to its own money, equity. It's like checking how much money you owe on your credit card compared to the money you have in your bank account. These ratios show if the company has taken on too much debt, which can be risky. Example, Company P and Company Q have similar revenues, but Company Q has a higher debt ratio. This indicates that Company Q has more debt compared to its equity, which might make it more vulnerable if it faces financial difficulties or economic downturns. Market ratios. Market ratios help us understand how investors view a company's stock. It's like checking if people think your favorite game console is worth its current price. These ratios show if the company's stock is valued highly by investors or not. Example, Company M and Company N are in the same industry, but Company M has a higher market ratio, like the price-to-earnings ratio. This means investors are willing to pay more for Company M's stock because they have confidence in its future growth and success. Efficiency ratios. Efficiency ratios measure how well a company is using its assets to generate sales or income. It's like checking how efficiently a farmer uses water and fertilizer to get a good crop yield. These ratios show if the company is making the most out of its resources. Example, Company Z and Company W have similar assets, but Company W has a higher efficiency ratio. This suggests that Company W is better at using its resources to generate sales or income, making it more effective in its operations. Why are they important? Understanding these ratio categories is important because comparison with peers. They allow us to compare a company's financial performance with others in the same industry, helping identify strengths and weaknesses. Investment decisions. Investors use these ratios to decide if a company is a good investment opportunity or not. Assessing financial health. These ratios give a comprehensive view of a company's financial health and performance. Management and strategy. Companies use these ratios to evaluate their performance and make informed decisions to improve their operations. Overall, ratio analysis is a powerful tool for understanding a company's financial performance, making sound investment decisions, and guiding strategic planning for the company's success. Benchmarking. Benchmarking in ratio analysis is like comparing how well a basketball player performs by comparing their stats to other players in the league. In business, we compare a company's financial ratios to those of similar companies in the same industry. It helps us see how the company stacks up against its competitors and whether its performance is above or below average. Example, imagine you run a bakery and you want to know if your profit margin, ratio of profit to sales, is good compared to other bakeries in your area. By looking at industry benchmark data, you find that the average profit margin for bakeries is 10%, but yours is 12%. This tells you that your bakery is doing slightly better than most others in the industry. Trend analysis. Trend analysis in ratio analysis is like looking at how a basketball player's performance has changed over the years to see if they are getting better or worse. In business, we look at how a company's ratios have changed over time to understand if it's improving or facing challenges. Example, let's say you invest in a tech company and you want to assess its financial health over the last 3 years. You look at its liquidity ratio, ability to pay debts, and it has been declining each year. This could be a warning sign that the company is having trouble managing its short-term obligations. Why are they important? Understanding benchmarking and trend analysis is crucial because performance comparison. Benchmarking allows us to see how well a company is doing compared to its industry peers. It helps us identify strengths and weaknesses and set performance goals. Identifying industry leaders. Benchmarking helps investors and analysts identify industry leaders, companies that are outperforming their competitors and may present good investment opportunities. Performance monitoring. Trend analysis helps us track a company's progress over time. Improving ratios indicate that a company is making better financial decisions and becoming more efficient. Early detection of issues. By monitoring trends, we can identify potential financial problems in a company before they become serious. This gives management an opportunity to take corrective actions. Investment decision making. Investors use benchmarking and trend analysis to make informed decisions about where to invest their money. A company with improving ratios and strong industry performance may be a more attractive investment option. In summary, benchmarking allows us to compare a company's ratios with industry peers, providing insights into its competitiveness. Trend analysis helps us track a company's performance over time, enabling us to spot improvements or potential issues. Together, these analytical techniques are essential for making informed business decisions and investment choices. Operating margin. Operating margin is like checking how much money a company makes from its sales after subtracting all the costs directly related to making and selling its products or providing its services. It's like seeing how much money a lemonade stand makes after taking into account the cost of lemons, sugar, and cups. Example: let's say a lemonade stand sells lemonades for $2 each. The cost of lemons, sugar, and cups for each lemonade is $0.50. The operating margin would be 75% because for each $2 lemonade sold, $1.50 is left as profit after covering the cost of making it. Gross profit margin. Gross profit margin is like checking how much money a company makes from its sales after subtracting the direct costs of producing or buying the goods it sells. It's like seeing how much money a bakery makes from selling cakes after subtracting the cost of ingredients and labor to bake them. Example: a bakery sells a cake for $20 and the cost of ingredients and labor to make the cake is $8. The gross profit margin would be 60% because for each $20 cake sold, $12 is left as profit after covering the direct production costs. Net profit margin. Net profit margin is like checking how much money a company makes from its sales after subtracting all the expenses, including the costs of making the product and other operating expenses. It's like seeing how much money you have left from your allowance after spending on food, entertainment, and other expenses. Example: a toy store sells toys for $100 and the total expenses, including the cost of buying the toys and other operating expenses, are $80. The net profit margin would be 20% because for each $100 worth of toys sold, $20 is left as profit after covering all expenses. Return on total assets, ROA. ROA is like checking how effectively a company is using its assets, things like buildings, equipment, and cash, to generate profits. It's like checking how much money you can make from the stuff you own, like selling lemonades using your lemonade stand and ingredients. Example: a company has $10,000 in assets, like machinery and cash, and makes a profit of $2,000. The ROA would be 20% because the company is making a 20% return on its $10,000 assets. Return on equity, ROE. Return on equity, ROE, measures how well a company is using the money invested by its owners, equity, to generate profits. It's like calculating how much profit you make for every dollar you invest in your lemonade stand. Example: if the owners invest $500 in a company and the company generates $100 in profit, the ROE would be 20%. This means the company is making a 20% return on the money invested by its owners. Why are they important? Understanding these profitability ratios is crucial because financial health. They give us insights into a company's financial health and how effectively it is generating profits from its operations. Comparing performance. By comparing these ratios with industry benchmarks or competitors, We can see how well a company is performing relative to others in the same field. Decision making. Investors and managers use these ratios to make informed decisions about the company's financial strategies and future investments, identifying strengths and weaknesses. These ratios help us identify areas where a company is performing well or needs improvement, guiding strategic decisions. Assessing profitability. Profitability ratios are essential for understanding how much profit a company is making from its sales and whether it's generating acceptable returns for its shareholders. In summary, profitability ratios give us valuable insights into a company's financial performance, allowing us to evaluate its profitability and efficiency in generating profits from its assets and equity. Current ratio. The current ratio helps us determine if a company can pay its short-term debts, like bills and loans, to within a year, using its short-term assets, like cash, inventory, and accounts receivable. It's like checking if you have enough money in your wallet to pay for all your upcoming expenses. Example, let's say a company has $10,000 in cash, $5,000 worth of inventory, and $3,000 in accounts receivable, money owed to them by customers. On the other side, it has $8,000 in short-term debts, bills and loans due within a year. The current ratio would be calculated as follows. Current ratio equals cash plus inventory plus accounts receivable slash short-term debts equals $10,000 plus $5,000 plus $3,000 slash $8,000 equals $18,000 slash $8,000 equals 2.25. A current ratio of 2.25 means that the company has $2.25 in short-term assets for every $1 of short-term debts. This indicates that the company can easily cover its short-term obligations. Quick ratio. The quick ratio, also known as the acid test ratio, is similar to the current ratio, but it excludes inventory from short-term assets. It helps us assess if a company can pay its short-term debts without relying on the sale of inventory. It's like checking if you can pay your bills without selling your collection of video games. Example, let's say the same company from the previous example has a quick ratio calculated as follows. Quick ratio equals cash plus accounts receivable slash short-term debts equals $10,000 plus $3,000 slash $8,000 equals $13,000 slash $8,000 equals 1.625. A quick ratio of 1.625 means that the company has $1.625 in short-term assets for every $1 of short-term debts. This still indicates that the company can cover its short-term obligations, even if it does not consider its inventory. Why are they important? Understanding these liquidity ratios is crucial because financial safety. Liquidity ratios tell us if a company has enough short-term assets to meet its immediate financial obligations. They show whether the company is financially safe in the short term. Creditor confidence. Lenders and suppliers use these ratios to assess the company's ability to repay debts promptly. Higher ratios indicate better liquidity and increase the confidence of creditors in lending money or providing goods on credit. Decision-making. Investors and managers use these ratios to make important decisions about financial planning and resource management. They help ensure that the company has enough cash flow to handle its day-to-day operations. Early warning signs. Declining liquidity ratios can be early warning signs of financial trouble. Low ratios may indicate that a company is struggling to meet its obligations, potentially leading to financial difficulties. In summary, liquidity ratios are crucial for assessing a company's short-term financial health and determining its ability to meet its immediate obligations. They provide valuable insights for decision-making, managing financial risks, and maintaining a stable and healthy business. Debt ratio. The debt ratio helps us understand how much of a company's total assets are financed by debt. It shows the proportion of a company's assets that are funded by borrowing money rather than by the owner's investment. Equity. It's like checking how much of your new bike is paid for with money you borrowed from your parents versus money you saved. Formula. Debt ratio equals total debt slash total assets. Simple example. Let's say company XYZ has total assets worth $100,000 and its total debt, long-term debts like loans or bonds, is $30,000. To calculate the debt ratio equals $30,000 slash $100,000 equals 0.30. Explanation. The debt ratio in this example is 0.30 or 30%. It means that 30% of company XYZ's total assets are funded by debt, and the remaining 70% is funded by the owner's investment, equity. Why is it important? Understanding the debt ratio is crucial because financial risk assessment. The debt ratio tells us how reliant a company is on borrowed funds. A higher debt ratio means the company has more debt relative to its assets, which can be riskier if the company faces financial challenges. Creditworthiness. Lenders and investors use the debt ratio to assess a company's creditworthiness. A lower debt ratio indicates that the company has a healthier financial structure and is better equipped to handle its long-term debt obligations. Stability and sustainability. A healthy debt ratio indicates that the company is stable and financially sustainable in the long term. It suggests that the company can manage its debt and maintain its operations without facing excessive financial strain. Comparison with industry peers. Comparing the debt ratio with industry averages or similar companies helps us understand if the company's debt level is in line with industry norms. Strategic decision making. Companies use the debt ratio to make informed decisions about their financial structure. For example, they may decide to reduce debt if the ratio is too high or leverage more debt for growth opportunities if the ratio is manageable. In summary, the debt ratio is a critical metric for assessing a company's financial health and evaluating its risk profile. It helps investors, creditors, and management understand the level of debt in the company's capital structure and make informed decisions about its financial stability and creditworthiness. Price/earnings ratio, P/E. The price/earnings ratio, often referred to as the P/E ratio, helps investors determine the relative value of a company's stock. It shows how much investors are willing to pay for each dollar of the company's net income, profits. It's like comparing the price you're willing to pay for a movie ticket based on the enjoyment you expect to get from the movie. Formula. P/E ratio equals stock price/earnings per share, EPS. Simple example. Let's say company ABC's stock is trading at $50 per share and its earnings per share, EPS, for the last 12 months is $5. To calculate the P/E ratio, P/E ratio equals $50/$5 equals 10. Explanation. In this example, the P/E ratio for company ABC is 10. It means investors are willing to pay $10 for each dollar of the company's earnings. Generally, a higher P/E ratio suggests that investors have higher expectations for the company's future growth and profitability. Why is it important? Understanding the P/E ratio is crucial because relative valuation. The P/E ratio helps investors compare the value of a company's stock to its earnings, allowing them to evaluate if the stock is overvalued or undervalued compared to similar companies. Expectations of growth. A high P/E ratio can indicate that investors have high expectations for the company's future growth. Conversely, a low P/E ratio may suggest that investors have lower expectations or perceive some risks. Investment decision-making. Investors use the P/E ratio to make informed decisions about buying or selling a company's stock. It provides insights into how the market perceives the company's potential for future earnings. Price-to-book ratio. The price-to-book ratio, also known as the P/B ratio, assesses how much value a company's management is creating from its assets. It compares the market value of a company's stock, its market capitalization, to the value of its net assets, book value. It's like checking if the price you are paying for a house is reasonable compared to its actual value in the real estate market. Formula: P/B ratio equals stock price slash book value per share. Simple example. Let's say company XYZ stock is trading at $80 per share and its book value per share is $40. To calculate the P/B ratio, P/B ratio equals $80 slash $40 equals 2 explanation. In this example, the P/B ratio for company XYZ is 2. It means investors are paying twice the book value for each share. A higher P/B ratio indicates that investors are willing to pay a premium for the company's assets, suggesting confidence in the company's management and potential growth. Why is it important? Understanding the P/B ratio is crucial because assessing value. The P/B ratio helps investors assess whether a company's stock is trading at a fair value based on its underlying assets. A low P/B ratio may suggest that the stock is undervalued, while a high ratio may indicate overvaluation. Management performance. The P/B ratio allows investors to evaluate how effectively a company's management is creating value from its assets. A higher P/B ratio indicates that the management is generating higher returns on the company's assets. Comparison with industry peers. Comparing the P/B ratio of a company with similar companies in the same industry helps in understanding its relative position and competitive advantage. Investment decision-making. Investors use the P/B ratio as a tool to make informed decisions about investing in a company's stock. It provides insights into the company's financial health and management's effectiveness. In summary, market ratios like the P/E ratio and the P/B ratio help investors assess the attractiveness of a company's stock in relation to its earnings and assets. They play a vital role in investment decision-making, helping investors identify opportunities and evaluate the potential for future growth and profitability. Ratio analysis. Ratio analysis is a method used to evaluate the financial performance and health of a company by examining the relationships between different financial figures. It involves calculating various ratios using the financial statements, such as the income statement and balance sheet, to gain insights into the company's profitability, efficiency, liquidity, and overall financial stability. These ratios help investors, analysts, and managers understand the company's strengths, weaknesses, and potential areas for improvement. DuPont equation. The DuPont equation is a specific type of ratio analysis that focuses on understanding the factors that contribute to a company's return on equity, ROE. ROE is a critical financial metric as it measures how effectively a company is generating profits from the shareholders' investments. The DuPont equation breaks down ROE into 3 key components, and each component represents a different aspect of the company's operations. Net income margin. This component measures the company's profitability and efficiency in managing its expenses. It shows what percentage of each sales dollar is left as profit after all expenses are accounted for. A high net income margin indicates that the company is effective in controlling costs and generating profits from its core operations. Total asset turnover. This component measures how efficiently a company utilizes its assets to generate sales. It shows the company's ability to generate revenue from its assets, such as inventory, equipment, and property. A higher asset turnover ratio implies that the company is effectively using its assets to drive sales. Leverage multiplier, also known as financial leverage or equity multiplier. This component examines the company's use of debt to finance its operations. It measures the proportion of a company's assets that are financed by debt, borrowed money, instead of equity, shareholders' investments. A higher leverage multiplier means the company relies more on debt financing, which can amplify returns when things are going well, but can also increase risks if the company faces financial challenges. Importance of the DuPont equation. The DuPont equation is essential for several reasons. Comprehensive analysis. By breaking down ROE into its components, the DuPont equation provides a more detailed and comprehensive view of a company's financial performance. It helps identify the specific areas where the company excels or struggles. Decision-making tool. For managers, the equation offers valuable insights into which aspects of the business need improvement. By understanding the key drivers of ROE, managers can make informed decisions to enhance the company's profitability and efficiency. Performance comparison. The DuPont equation allows for easy comparisons between different companies within the same industry. It helps investors and analysts gauge which company is more efficient in utilizing its resources and which one is more reliant on debt financing. Indicator of financial health. ROE is a fundamental measure of a company's financial health and its ability to provide returns to its shareholders. Understanding the components of ROE helps investors assess the company's stability and potential for growth. In simple terms, the DuPont equation shows how a company's profitability, asset utilization, and debt management come together to determine its overall financial performance. By understanding these components, managers can make better decisions, and investors can make more informed choices about where to invest their money. Ratio analysis. Ratio analysis is a method used by businesses and investors to better understand a company's financial health. It involves comparing different financial figures from a company's financial statements to get a clearer picture of how well the business is doing. The DuPont equation. The DuPont equation. Return on equity equals net income margin x total asset turnover x leverage multiplier. The DuPont equation is a specific ratio that helps us dig deeper into a company's return on equity, ROE. Return on equity is a measure of how much profit a company is generating compared to the money invested by its shareholders. The DuPont equation is made up of three important components, and when you multiply them together, you get the ROE. Net income to sales ratio. This ratio tells us how much profit a company is making for every dollar of sales it generates. It shows how efficient the company is at turning its revenue into profit. Sales to total assets ratio. This ratio reveals how many dollars of sales a company is generating for each dollar it has invested in assets, like buildings, equipment, inventory, etc. It indicates how well the company is using its assets to generate sales. Total assets to total equity ratio. This ratio shows how much of the company's assets are funded by shareholders' equity. It indicates the proportion of the company's resources that are financed by the owners versus external sources like loans. Why are they important? Understanding the DuPont equation and using ratio analysis is crucial for a few reasons. Insight into profitability. By looking at the DuPont equation, we can understand the factors driving a company's profitability. If any of the ratios are too low, it can highlight areas where the company needs to improve. Identifying efficiency. The ratios in the DuPont equation help us see how well a company is managing its resources. For example, if the sales to total assets ratio is low, it might mean the company is not using its assets efficiently to generate sales. Risk assessment. Investors and creditors use ratio analysis to assess the financial health and risk of a company. It gives them a better idea of the company's ability to repay debts and how well it can weather economic downturns. Comparisons. Ratios allow us to compare companies within the same industry. It helps us understand which companies are performing better than others and why. Overall, ratio analysis and the DuPont equation give us valuable insights into a company's financial performance and help us make informed decisions about investments or business strategies. It's like a financial health checkup that guides us on how well a company is doing and what it can do to improve its profitability and efficiency. Let's break down the DuPont equation and its three components: net income margin. Net income margin is a measure of how much profit a company makes for each dollar of revenue it generates. It tells us what percentage of the company's total revenue is left as profit after deducting all expenses. A high net income margin means the company is efficient in controlling costs and turning sales into profits. Why it's important? A high net income margin is important because it shows that the company is earning a good amount of profit from its sales, which is a sign of financial health and efficiency in managing its operations. Total asset turnover. Total asset turnover measures how efficiently a company uses its assets, like machinery, inventory, etc., to generate sales revenue. It shows how much sales the company is generating for each dollar it has invested in its assets. A high total asset turnover means the company is effectively utilizing its resources to generate sales. Why it's important. A high total asset turnover is important because it indicates that the company is making the most out of its assets, and this efficiency can lead to higher profits and a better return on investment. Leverage multiplier. The leverage multiplier, sometimes called the equity multiplier, measures the level of debt a company uses to finance its operations. It tells us how much debt the company has taken on relative to its equity. Shareholders' investment. Higher leverage means the company relies more on debt financing. Why it's important. The leverage multiplier is important because debt can amplify both gains and losses. When the company performs well, using debt can boost returns to shareholders. However, when things go south, high debt levels can also increase the risk of financial distress. Return on equity, ROE. Finally, return on equity is the ultimate result of combining the three components mentioned above. It represents the overall profitability of the company from the perspective of its shareholders. ROE shows how much profit the company generates for each dollar of shareholders' equity invested. Why it's important. Return on equity is a crucial metric for shareholders as it directly relates to the return they can expect on their investment in the company. A high ROE indicates that the company is generating substantial profits in proportion to the money invested by shareholders, making it an attractive investment option. In summary, the DuPont equation helps managers and investors understand what factors are driving a company's return on equity. By focusing on improving each of the three components, net income margin, total asset turnover, and leverage multiplier, a company can work towards increasing its overall profitability and providing better returns to its shareholders. It's like a toolkit that helps identify areas where the company is doing well and where it needs to make improvements to become more successful in the long run. Net income to sales ratio. Net income to sales ratio, also known as profit margin, is a measure of how much profit a company makes for every dollar of sales it generates. It shows what percentage of the company's sales revenue is left as profit after all the expenses have been deducted. A higher profit margin means the company is efficient at managing costs and making profits from its sales. Why it's important. Profit margin is important because it tells us how well the company is doing in terms of turning its sales into actual profit. It shows whether the company is earning a healthy profit from its operations. Sales to total assets ratio. The sales to total assets ratio measures how efficiently a company uses its assets to generate sales revenue. It shows how much sales the company is making for each dollar invested in its assets. A higher ratio means the company is generating more sales with a relatively lower investment in assets. Why it's important. This ratio is important because it indicates how well the company is utilizing its assets to generate revenue. A higher ratio suggests that the company is effectively using its resources to make sales, which is a good sign of operational efficiency. Total assets to total equity ratio. The total assets to total equity ratio, also known as the leverage ratio, compares the company's total assets to the amount of money invested by shareholders' equity. It shows how much of the company's assets are funded by debt, liabilities, and how much by shareholder investment. Why it's important. The leverage ratio is important because it helps us understand the financial structure of the company. A higher ratio means the company relies more on borrowing debt to finance its operations, while a lower ratio indicates that the company is using more of its own money, shareholder equity. Return on equity, ROE. Return on equity is the ultimate result of combining the three components mentioned above. It represents the overall profitability of the company from the perspective of its shareholders. ROE shows how much profit the company generates for each dollar of shareholders' equity invested. Why it's important. ROE is a crucial measure for shareholders because it tells them how effectively their investment in the company is being used to generate profits. A higher ROE means the company is providing better returns to its shareholders. In summary, the DuPont equation with its components, written in this way, helps us understand the factors that influence a company's return on equity. By looking at each component, net income to sales ratio, sales to total assets ratio, and total assets to total equity ratio, we can analyze how efficiently the company is operating, how well it utilizes its assets, and how much debt it uses to finance its growth. These insights can guide managers and investors in making informed decisions to improve the company's financial performance and create value for shareholders. Dividends. Dividends are like rewards that a company gives to its shareholders for being part owners of the company. When you buy shares of a company's stock, you become a shareholder. And since you're a part owner, the company may share some of its profits with you in the form of dividends. It's like getting a little bonus for being a loyal supporter of the company. Two things a firm can do with net income. A company earns money from its business activities, which is called net income. Once a company has its net income, it has two main choices on what to do with that money: pay dividends to shareholders. The company can decide to share a part of its profits directly with its shareholders as dividends. They do this on a per-share basis, meaning for each share of stock you own, you get a certain amount of money as a dividend. So, the more shares you have, the more dividends you'll receive. It's like getting a special gift from the company just because you own a piece of it. Retain the money in the company, retained earnings. Alternatively, the company may decide to keep the money within the company for future needs and growth. When a company keeps the money, it's called retained earnings. They use this money to invest in new projects, buy more equipment, hire more people, or just save it for a rainy day. By doing this, the company is trying to make itself even better and stronger for the future. Why dividends are important. Dividends are important for a few reasons. Rewarding shareholders. Dividends are a way for companies to show their appreciation to the shareholders who have invested their money in the company. It's like saying, "Thank you for believing in us and being a part of our success." Attracting investors. Dividends can make a company's stock more attractive to potential investors. People like to invest in companies that share their profits because it gives them a regular income stream, almost like a little paycheck. Indicating financial health. When a company regularly pays dividends, it's often seen as a sign of financial stability and confidence in the company's future. It shows that the company is making enough profit to share with its shareholders while still keeping the business strong. Simple example. Let's say you and your friend start a lemonade stand together. At the end of the day, you count all the money you earned from selling lemonades. That total amount is like the net income for your lemonade stand. Now, you and your friends have two choices. You can either share some of the money among yourselves as a dividend, or you can decide to keep it in the lemonade stand's piggy bank for future use, like buying a bigger lemonade stand or more ingredients. If you choose to give some money to each of your friends as a dividend, they will be happy because they earned a little extra for being part of the lemonade stand. But if you keep the money in the piggy bank as retained earnings, your lemonade stand might grow bigger, and you can have more fun together and make even more money in the future. So, dividends are a way to share the joy of success with those who helped create it, and they also help in planning for a stronger and better future. Dividend payout ratio. Imagine you have a lemonade stand, and at the end of the day, you count how much money you made, your net income. Now, instead of keeping all that money for yourself, you decide to share some of it with your friends who helped you run the stand, your shareholders. The dividend payout ratio is just a way to measure how much of your earnings you shared as dividends. Let's say your lemonade stand made $100 in profit, net income, and you decide to give $20 to your friends. In this case, your dividend payout ratio would be dividend payout ratio B equals dividends $20 slash net income $100 equals 20%. So you shared 20% of your net income with your friends as dividends. Why is the dividend payout ratio important? The dividend payout ratio is essential for both the company and its shareholders. For the company, it shows how much of its profits are being returned to the shareholders. It also indicates how much money the company is retaining to reinvest in its growth or use for other purposes. A higher payout ratio means the company is giving away more of its profits, leaving less money for expansion or dealing with unexpected expenses. For shareholders, the dividend payout ratio helps them understand how much dividend income they can expect to receive relative to the company's earnings. A high ratio might be attractive to income-seeking investors who want steady dividends, while a lower ratio might suggest the company is reinvesting more for potential future growth. Retention ratio. The retention ratio is just the opposite of the dividend payout ratio. It tells you how much of the company's earnings it decides to keep and reinvest rather than distribute as dividends. Let's use the same lemonade stand example. If you paid $20 as dividends to your friends, the amount you retained, kept, for yourself would be retention ratio R equals 1. Dividend payout ratio B equals 1 to 0.20 equals 0.80 or 80%. So you retained 80% of your net income to either improve your lemonade stand, buy more supplies, or save for the future. Why is the retention ratio important? The retention ratio is crucial because it shows how much money the company is plowing back into the business. A high retention ratio means the company is reinvesting most of its earnings to grow, develop new products, expand into new markets, or pay off debts. This can be a good sign for investors, as it indicates the company is focused on expanding and potentially generating higher profits in the future. On the other hand, a low retention ratio suggests that the company is paying out a significant portion of its earnings as dividends rather than reinvesting in itself. While dividends are nice for shareholders, a very low retention ratio might mean the company is not putting enough money back into the business for future growth, which could impact its long-term sustainability. In summary, the dividend payout ratio and retention ratio are both important measures for investors to understand how a company is using its profits. They offer insights into the company's dividend policy and growth strategy, which can be crucial for making informed investment decisions. Return on assets, ROA. Imagine you have a lemonade stand. ROA is like looking at how well you're using the things you have, like the table, chairs, and lemonade ingredients, to make money. It tells you how much profit you make for every dollar of assets you have. So, a higher ROA means you're doing a good job using your resources efficiently to make more money. Why it's important? ROA is crucial because it shows how well the company is managing its assets to generate profits. If the ROA is high, it means the company is making good use of its resources and is likely to be a well-run business. On the other hand, a low ROA may indicate that the company needs to improve its asset management to increase profitability. Return on equity, ROE. Now, let's say you decided to sell shares in your lemonade stand to your friends, and they invested money to help you grow the business. Rora looks at how well you're using that money from your friends, the equity, to make profits. It tells you how much profit you make for every dollar of equity invested in the business. So, a higher ROE means your friend's money is being used effectively to earn more profit. Why it's important? ROE is important because it shows how efficient the company is at generating profits from the money invested by shareholders. As an owner or investor, you want to see a high ROE because it means your money is being put to good use and earning you more returns. It also indicates that the company is financially healthy and has the potential to attract more investors. Sustainable Growth Rate, SGR. Imagine you want your lemonade stand to grow and become a bigger business. The sustainable growth rate is like a prediction of how fast your lemonade stand can grow without taking on too much debt or selling too many additional shares to investors. It's based on the ROE because the more profit you can make from your existing money, the more you can reinvest in the business to make it grow sustainably. Why it's important? The sustainable growth rate is a vital metric for businesses because it helps them plan their growth strategy. If a company grows too fast without generating enough profits, low ROE, it might run into financial trouble or become less attractive to investors. On the other hand, if the company's ROE is high, it can use its profits to fund expansion and grow steadily without jeopardizing its financial health. In summary, ROA tells us how well a company is using its assets to make money, while ROV shows how effectively it's using shareholders' money for the same purpose. A high ROA and ROE are desirable, as they indicate a well-managed and profitable business. The ROE also helps determine the company's sustainable growth rate, which is crucial for planning the business's expansion in a healthy and steady manner. Ratio analysis is a way to understand how a company is doing financially by using simple comparisons between different numbers from its financial statements. These numbers are put into groups called ratios, and there are five main types of ratios used for this analysis: profitability, liquidity, activity, debt, and market ratios. Here's a breakdown of what these ratios mean. Profitability ratios. These ratios tell us how well a company is using its assets and managing its expenses to make a good profit. Liquidity ratios. These ratios show whether a company has enough cash to pay off its short-term debts. It's like checking if you have enough money in your wallet to pay your immediate bills. Activity ratios. These ratios measure how efficiently a company is using its resources, like how well they are managing their inventory or how quickly they collect money from customers. Debt ratios. These ratios help us see if a company can handle its long-term debts and if it's in a good position to repay them. Market ratios. These ratios are important for shareholders. They help them understand the value of their investment in the company's shares and how the stock is doing in the market. By looking at these ratios, investors and managers can get a clearer picture of how well the company is performing and whether it's a good investment or not. It's like using math to get a better understanding of a company's financial health. Simple explanation. Ratio analysis is like using math to understand how well a company is doing financially. It involves comparing different numbers from a company's financial statements to see if it's making profits, managing debts, and using its resources effectively. There are five types of ratios used: profitability, liquidity, activity, debt, and market ratios. Mental models and analogies. Recipe ingredients. Think of ratio analysis as following a recipe for a cake. Each ratio is like an important ingredient. If you get the right ratios in the right proportions, you'll have a delicious cake, a successful company. But if you mess up the ratios, the cake might not turn out well. The company might face financial problems. Health checkup. Imagine the company as a person, and ratio analysis is like a health checkup. The doctor-investor uses different tests, ratios, to assess the person's health, company's financial health. They check the person's heart rate, liquidity, weight, debt, energy levels, profitability, and how efficiently they use resources, activity. Example exercises. Let's practice with some simple questions. A. Question. What does liquidity ratio measure? Answer. Liquidity ratio measures how easily a company can pay its short-term debts using its available cash. B. Question. What does profitability ratio show? Answer. Profitability ratio shows how well a company is making profits from its assets and controlling its expenses. C. Question. Why is ratio analysis important for investors? Answer. Ratio analysis helps investors understand the company's financial strengths and weaknesses, making it easier for them to decide if it's a good investment. Advantages and disadvantages and importance. Advantages. Easy comparison. Ratios simplify complex financial information, making it easier to compare companies and make investment decisions. Identifying trends. Ratio analysis helps spot trends over time, showing if a company's financial situation is improving or deteriorating. Business decisions. Managers use ratios to make informed decisions about their company's operations and financial strategies. Disadvantages. Limited insight. Ratios don't provide the whole picture of a company's financial health. They are just one tool among others for analysis. Industry differences. Ratios may vary widely between industries, so comparing ratios from different industries may not be accurate. Importance: decision making. Ratio analysis aids in making informed decisions for investing, lending, or managing a company. Financial health. It helps assess the financial health and performance of a company. Early warning. It can act as an early warning system, signaling potential financial troubles. Understanding ratio analysis is crucial for investors, managers, and anyone interested in a company's financial health. It allows for better decision making and helps avoid risky investments or business decisions. Key points I should know about this section. What is ratio analysis? It's a method to understand a company's financial performance by using 5 types of ratios: profitability, liquidity, activity, debt, and market ratios. Ratios from financial statements. Ratio analysis involves calculating ratios from a company's financial statements, like the balance sheet and income statement. Financial ratio definition. A financial ratio is a number that compares different values from financial statements to give us useful information. Putting numbers into context. Financial statements alone may not tell the whole story. Ratio analysis puts these numbers into context to help investors understand various aspects of the company's operations. Investors' tool. Ratio analysis is a tool that investors use to gain insights into a company's financial health and performance. Liquidity ratio. It measures how easily a company can pay its short-term debts using available cash. Profitability ratio. This ratio shows how well a company is making profits from its assets and controlling expenses. Activity ratio. Also called efficiency ratios, they measure how effectively a company uses its resources, like inventory and assets. Debt ratio. It helps determine if a company can handle its long-term debts and whether it's in a good position to repay them. Market ratio. This ratio is relevant to shareholders. It shows the relationship between the return on investment and the value of the company's shares. Use of financial ratios. These ratios are used by managers, shareholders, creditors, and other interested parties to understand a company's strengths and weaknesses. Importance of ratio analysis. Ratio analysis is essential for decision-making, understanding a company's financial health, and assessing its risk and profitability. Remember, ratio analysis provides valuable insights into a company's financial performance, helping investors and managers make informed decisions. It's like using a set of measuring tools to understand how well a company is doing and if it's a good investment. Ratio analysis is a way to understand how a company is doing financially by looking at its financial statements. It uses ratios, which are special numbers, to compare different parts of the statements over time or with other companies. Most of the data used for ratio analysis comes from these financial statements. Before calculating the ratios, analysts might make adjustments to the statements to make the ratios more useful and accurate. For example, they may separate regular earnings from one-time events to get a clearer picture. This analysis helps investors and analysts get a better idea of a company's financial health and performance. It's like examining a company's money situation closely to see if it's doing well or not. Simple explanation. Ratio analysis is like using clues from a company's financial statements to understand how well it's doing financially. We use special numbers, ratios, to compare different parts of the statements and see if the company is doing better or worse over time or compared to others. 2. Mental models and analogies. Financial health thermometer. Think of ratio analysis as a thermometer that measures a company's financial health. Just like a thermometer helps you know if you have a fever, a health problem, ratios help you know if a company has financial issues or is doing great. Ingredients in a recipe. Ratios are like important ingredients in a recipe for understanding a company. Each ratio gives us valuable information about the company's financial situation, just like each ingredient adds to the taste of a dish. 3. Example exercises. A. Question. What is ratio analysis used for? Answer. Ratio analysis helps us understand a company's financial health by comparing numbers from its financial statements. B. Question. What do analysts do before calculating financial ratios? Answer. Before calculating ratios, analysts may adjust the financial statements to make the ratios more useful for comparisons. C. Question. Why is ratio analysis important for investors? Answer. Ratio analysis is important for investors because it helps them make informed decisions about investing in a company. 4. Advantages and disadvantages and importance. Advantages. Easy understanding. Ratio analysis simplifies complex financial information, making it easier to interpret. Decision making. It helps investors and managers make informed decisions about a company's financial health. Comparison tool. Ratios allow easy comparisons between different companies or over time. Disadvantages. Limited picture. Ratios don't show the full story of a company's financial health and should be used with other analysis tools. Industry differences. Ratios may not be comparable across different industries. Importance. Investment decisions. Ratio analysis is vital for making wise investment choices. Financial health check. It helps us understand if a company is stable or facing problems. Company assessment. Ratio analysis lets us assess a company's strengths and weaknesses. Understanding ratio analysis is crucial for anyone interested in business and investing. It helps you make smart financial decisions and see through the numbers to know if a company is on the right track or facing challenges. Data source. Most of the data used in ratio analysis comes from a company's financial statements. Purpose of ratio analysis. Ratio analysis is a tool used to evaluate a company's financial statements and compare its performance over time or with other companies. Reformulation and adjustment. Before calculating ratios, analysts often adjust the financial statements to make the ratios more meaningful and accurate for comparisons. Earnings management. Earnings management refers to fraudulent accounting practices used to manipulate income, assets, or liabilities to influence interpretations of financial statements. Valuation. Valuation is the process of estimating the market value of a financial asset or liability. Financial statements. These are important documents that show a company's financial position and results. Contextualizing information. Ratios put the information from financial statements into context, making it easier to understand a company's financial health. Putting numbers in order. Evaluating financial statements involves organizing the numbers and using them to perform ratio analysis. Separating earnings. Analysts may separate earnings into recurring, regular, and non-recurring, special items to better understand a company's financial performance. Relevance of normal earnings. Normal or core earnings are more relevant for predicting and valuing a company's future performance. Bottom-up analysis. Ratio analysis is a form of fundamental analysis, which means it focuses on specific company financials rather than external factors. Importance of company financials. Ratio analysis helps investors and analysts make informed decisions about a company's financial health and potential. Understanding these key points will allow you to grasp the basics of ratio analysis, helping you assess a company's financial performance and make better investment decisions. Ratio analysis is a way to compare different companies to see how well they are doing financially. It's like looking at their financial health to see if they are doing better or worse than others. When we compare companies within the same industry, it's like comparing apples to apples. It's helpful because they are doing similar kinds of business, and we can see who's doing better in that specific field. But when we compare companies from different industries, it's like comparing apples to oranges. It's not as helpful because they might have different reasons for their financial numbers to be the way they are. So we need to be cautious when doing these cross-industry comparisons. An industry is a group of companies that do similar kinds of economic activities. However, the definition of an industry can be too broad or too narrow for the purposes of comparing financial ratios. When we compare ratios, we want to make sure that the companies we are comparing have similar financial characteristics. This way, the comparison is more meaningful and accurate. Valuation using multiples is another way to look at how much a company is worth. It involves comparing a company's value to other similar companies in its industry. However, this method has its limitations because different industries have different ways of valuing their companies. So, in summary, ratio analysis is helpful for comparing companies within the same industry, but we should be careful when comparing companies from different industries. Valuation using multiples can be useful, but it has some limitations, and we need to make sure the companies we compare are truly comparable. Ratio analysis is like a tool to assess how well companies are doing financially, and it's great for comparing companies within the same industry because they are like similar items, apples to apples. However, when we compare companies from different industries, it's like comparing different things, apples to oranges, which may not give us an accurate picture. So we should be cautious with cross industry comparisons. Furthermore, an industry is a group of companies doing similar types of business. But sometimes the definition of an industry can be too broad or too narrow for comparing financial ratios effectively. When comparing ratios, it's essential to make sure the companies being compared have similar financial characteristics to have a meaningful and accurate comparison. Valuation using multiples is another way to determine a company's worth by comparing it to other similar companies in its industry. However, this method has its limitations because different industries value companies differently. In conclusion, ratio analysis is helpful for comparing companies within the same industry, but we should be careful when comparing companies from different industries. Valuation using multiples can be useful, but we need to ensure the companies we compare are genuinely comparable to get meaningful results. Simple explanation. Ratio analysis is like comparing the financial health of different companies to see how well they are doing. It's helpful when comparing companies within the same industry because they are similar, but we should be careful when comparing companies from different industries because they can be very different. Mental models and analogies. Fruit stand analogy. Imagine you have a fruit stand where you sell apples, oranges, and bananas. Each type of fruit represents a different industry. Ratio analysis would be like comparing how many apples are sold in a day, how many oranges are sold in a day, and how many bananas are sold in a day. It's easier and more meaningful to compare apples to apples, companies within the same industry, than comparing apples to oranges, companies from different industries. Sports team analogy. Think of different sports teams competing in various leagues. Each league represents an industry. When comparing teams within the same league, you can see which team is performing better and why. However, comparing teams from different leagues might not provide useful insights because the rules, competition, and conditions can be very different, just like in different industries. Example exercises. Exercise 1. Which is a better comparison for ratio analysis? Two software companies or a software company and an oil company. Why? Comparing two software companies is a better comparison because they are both part of the same industry, and their financial characteristics are likely to be more similar, making the comparison more meaningful. Exercise 2. Why we need to be cautious when comparing the price-to-earnings ratio of a tech company and a construction company. We need to be cautious when comparing the price-to-earnings ratio of a tech company and a construction company because their industries are very different. Tech companies usually have high growth potential, while construction companies might have steadier but slower growth. So, their price to earnings ratios may not be directly comparable. Advantages and disadvantages and importance. Advantages of ratio analysis within the same industry. Helps identify strengths and weaknesses of a company compared to its competitors. Provides insights into industry norms and best practices. Allows benchmarking against the top performers in the same field. Disadvantages of cross-industry comparisons. Industries can have different accounting methods and financial characteristics, making comparisons less meaningful. External factors affecting industries can be vastly different, leading to incomparable results. Companies in different industries may have different goals and strategies, making their financial ratios less comparable. Importance of understanding valuation using multiples. Valuation helps investors determine if a company's stock is overpriced or undervalued. Using multiples can give a quick snapshot of a company's value compared to its peers. Recognizing the limitations of valuation methods is crucial to making informed investment decisions. In summary, ratio analysis is a powerful tool to understand how companies are performing financially, especially when comparing companies within the same industry. Cross-industry comparisons can be tricky due to differences in industries, so it's essential to exercise caution. Valuation using multiples helps assess a company's worth, but it has its limitations, and understanding them is essential for making informed investment choices. Key points I should know about this section: ratio analysis helps compare companies. Ratio analysis is a tool to compare how well different companies are doing financially. It's like checking their health to see if they are doing better or worse than others. Advantages of ratio analysis: it allows comparing companies within the same industry. This is useful because they do similar kinds of business, making it easier to see who's performing better in that specific field. Be cautious with cross-industry comparisons. While ratio analysis is helpful within the same industry, comparing companies from different industries can be like comparing apples to oranges. They might have different reasons for their financial numbers, making the comparison less meaningful. Industry represents classification. An industry is a group of companies doing similar kinds of economic activities. However, it's essential to be careful with the definition of an industry when doing ratio analysis, as it can be too broad or too narrow. Comparable companies in ratio analysis. To get meaningful comparisons, companies being analyzed should have similar characteristics in the financial metrics being studied. We want to compare like to like, apples to apples. Valuation using multiples. Valuation is the process of estimating a company's market value. Multiples are a way to compare a company's value to other similar companies in its industry. Statistical relationship for useful multiples. For multiples to be useful, the statistic involved, like earnings or cash flow, must have a logical and meaningful relationship to the observed market value. This relationship can vary across industries. Peer group and valuation. A peer group is a set of companies or assets selected for comparison because they are comparable to the company being valued, usually by being in the same industry or having similar characteristics. Industry comparisons like apples to apples. Comparing ratios of companies within the same industry is more useful because it's like comparing apples to apples, similar businesses being analyzed together. Industry classification levels. Industries can be classified into different levels, from broad sectors like primary, secondary, and tertiary to detailed classification systems like ISIC. Different ratios for different reasons. Different types of businesses will have different financial ratios for various reasons, so it's essential to consider the context when comparing them. Limitations of multiples in valuation. Using multiples only shows relative values and not absolute values. Additionally, comparing ratios across different industries can be challenging due to varying capital structures and industry valuations. Understanding these key points is crucial for making informed decisions in finance and investments. Ratio analysis helps investors and analysts assess company performance, but it's essential to use it wisely within the same industry. Valuation using multiples provides insights into a company's worth, but its limitations must be considered to avoid making incorrect assessments during market fluctuations. Ultimately, these tools can aid in making smarter investment choices and understanding the financial landscape of different businesses. Benchmarking is like comparing how well a company is doing compared to others in its class or industry. It involves looking at financial ratios, which are numbers that show comparisons between different things. Financial ratios let us compare different companies to see how they are performing. We can use these ratios to benchmark our company's performance against others in the same industry or even against our own performance at different times. Imagine we have a bunch of companies in the same industry. Benchmarking would be like finding the best companies in that group and comparing how well they are doing with their finances. Then we look at our own company's financial numbers and see how they measure up to the top performers. One way to do this is using ratio analysis, where we use established calculations based on real data to make comparisons. It's like having a set of reliable rules to compare companies fairly. Benchmarking can be helpful to different people. Investors use it to decide if a company is a good investment compared to other choices. Managers use it to see how their company stacks up against competitors using concrete data. Overall, benchmarking with financial ratios helps us see how well a company is doing compared to others and can guide investors and managers in making better decisions. Simplified explanation for benchmarking and financial ratios. Imagine you are a basketball player trying to improve your skills. Benchmarking is like looking at the best player in your team or league and comparing your performance to theirs. You check how many baskets they make, how fast they run, and how accurate they are. These comparisons help you figure out what you need to work on to become better. Financial ratios are similar. They are like numbers that represent how well a company is doing financially. Instead of basketball skills, we look at things like how much money they make compared to how much they spend, or how much they owe compared to how much they own. By comparing these ratios to the best companies in their industry, we can see where the company is doing well and where it needs to improve. Mental model. Company health report card. Think of a company's financial ratios as a report card that tells you how healthy the company is. Just like a student's report card shows grades for different subjects, a company's financial ratios show different aspects of its financial health. For example, profitability ratio. This is like the company's math grade, showing how good they are at making money. Liquidity ratio. This is like the emergency fund grade, showing how prepared the company is to handle unexpected expenses. Debt ratio. This is like the debt management grade, showing how well the company handles its loans. By comparing the company's ratios to the top performing companies, the A-plus students or the average in the industry, we can see which areas the company excels in and which areas need improvement, just like a student can see which subjects they are strong in and which need more study. Example exercise. Let's practice with a quick exercise. I'll give you a question related to financial ratios and benchmarking, and you can try to answer it. Question. Company A and Company B are in the same industry. Company A has a profit margin ratio of 15%, and Company B has a profit margin ratio of 12%. Which company has a better profit margin ratio, and what does this ratio tell us about their financial performance? Answer. Company A has a better profit margin ratio because it's 15% compared to Company B's 12%. The profit margin ratio shows what portion of a company's revenue is turned into profit. A higher ratio means the company is more efficient at generating profits from its sales, which is a good sign for investors and managers. Advantages and disadvantages of benchmarking and financial ratios. Advantages. Clear comparison. Benchmarking allows companies to compare their performance against industry leaders or averages, providing a clear picture of where they stand. Identifying strengths and weaknesses. By analyzing financial ratios, companies can identify areas of strength to maintain and weaknesses to improve. Objective decision-making. Benchmarking provides objective data for decision-making, helping companies set realistic goals and strategies. Investor and stakeholder insight. Financial ratios aid investors and stakeholders in understanding a company's financial health and potential. Disadvantages. Data availability and accuracy. Benchmarking requires accurate and up-to-date data, and sometimes this data might not be easily accessible or reliable. Industry differences. Industries vary significantly, and comparing ratios across different industries might not give meaningful insights. Overlooking unique factors. Companies have unique characteristics, and focusing solely on benchmarking may lead to overlooking critical individual aspects. Importance of knowing benchmarking and financial ratios. Knowing about benchmarking and financial ratios is crucial for both investors and managers. Investors can use these tools to assess a company's financial health, compare it with other investment opportunities, and make informed decisions. On the other hand, managers can identify areas for improvement, set performance targets, and make data driven decisions to enhance their company's overall performance. Understanding these concepts helps businesses stay competitive, make better financial decisions, and achieve sustainable growth. Key points I should know about this section: benchmarking definition. Benchmarking is the process of comparing one company's performance, financial ratios, to that of other companies, particularly top performers or industry averages, to identify areas for improvement. Financial ratios. Financial ratios are numbers that help evaluate a company's financial health. They represent comparisons between different financial variables, such as revenue, profit, debt, and equity. Purpose of benchmarking. Benchmarking allows businesses to set goals and strategies based on industry best practices, improve processes, and enhance overall performance. Comparison scope. Benchmarking can involve comparing a company to top performers in the same industry or the average performance of similar companies in the peer group. Ratio analysis in benchmarking. Ratio analysis is a key component of benchmarking, where financial ratios are used to make quantitative comparisons between companies. Well-established ratios. Financial ratios are based on well-established calculations derived from verified financial data, making them reliable and widely used in benchmarking. Audience for benchmarking. Benchmarking using ratio analysis is beneficial for various audiences, such as investors and managers who seek quantitative insights into a company's performance. Benchmarking and investor perspective. Investors use benchmarking to compare a company's financial ratios to those of its peers, helping them assess the company's attractiveness as an investment opportunity. Benchmarking and management perspective. Managers use benchmarking to evaluate their company's performance against competitors, identify strengths, and discover areas needing improvement. Multiple benchmarking approaches. Benchmarking can be performed in various ways, not limited to ratio analysis. Other techniques include process benchmarking and strategic benchmarking. Changing definitions and priorities. Over time, benchmarking criteria may change within an organization due to shifts in leadership or priorities. Consistency in metrics definitions is vital for meaningful comparisons. Importance of common metrics. Effective benchmarking requires common and consistent metrics between compared units and over time to ensure accurate and relevant comparisons. By understanding these key points, you'll be able to grasp the significance of benchmarking and financial ratios in assessing a company's performance and making informed decisions. Trend analysis is all about looking at numbers and data from a company over time, like checking its progress on certain things. We use ratios, which are comparisons between different numbers, to do this. For example, we might compare how much money a company makes now compared to a few years ago. We put all this data into tables or charts to spot any patterns or trends. This trend analysis helps us make predictions about the company's future or make decisions based on how it's been doing in the past. It's like looking at how popular a topic has been over time using a graph. We can see if it's becoming more or less popular. There are different ways to do trend analysis in finance. One way is called technical analysis, where we study a company's stock prices and trading volume to see which direction it's going. Another way is fundamental analysis, where we look at a company's financial statements, especially ratios, to understand its performance. However, trend analysis can get tricky because companies and accounting methods can change over time. For example, a company might start doing something different or change how they handle their finances. So, analysts need to be careful and make adjustments to the ratios to get a clearer picture. Overall, trend analysis helps us understand a company's past performance and make better choices for the future. It's like learning from history to make smart decisions in the present. Trend analysis is like looking at a company's progress over time using ratios, which are comparisons of different numbers. We collect information and check if there are any patterns or trends in how the company has been doing. This helps us predict or make decisions about its future. However, it can be tricky because companies may change how they do things, and we need to be careful when comparing the numbers. 2. Mental model. Company's growth journey. Imagine a company as a person on a journey of growth. Trend analysis is like looking at the pictures from their past and seeing how they've changed over time. We use ratios to compare different aspects of their life, like how much money they make or how much they owe. By putting these pictures side by side, we can spot patterns and see if they are improving or facing challenges. This helps us understand their journey and make guesses about what might happen in their future. 3. Example exercises. Exercise 1. Company XYZ's profit margin ratio over the past 5 years was 10%, 12%, 9%, 14%, and 11%. What trend do you observe in the profit margin ratio over these years? The trend in company XYZ's profit margin ratio seems a bit inconsistent. It went up and down over the years, with the highest being 14% and the lowest being 9%. It's not showing a clear pattern of consistent growth or decline. Exercise 2. Why is it important to consider changes in a company's business model or accounting practices when doing trend analysis with financial ratios? It's important to consider changes in a company's business model or accounting practices because they can significantly impact the financial ratios over time. If a company starts doing something new or changes the way it handles its finances, the ratios might not give an accurate picture of their actual performance. Adjusting for these changes helps us get a more reliable trend analysis. Advantages and disadvantages and importance of trend analysis. Advantages: predicting future performance. Trend analysis helps forecast a company's future performance based on its past trends and patterns. Identifying strengths and weaknesses. It helps pinpoint areas where a company is improving or facing challenges, aiding in decision-making. Informed decision-making. Trend analysis assists investors and managers in making informed choices about investments and strategies. Disadvantages: data complexity. Financial ratios involve complex data, and changes in accounting or company structure can complicate analysis. Short-term biases. Trend analysis might not capture long-term trends if it focuses on a short time frame. External factors. Factors like economic changes or market trends can influence a company's performance, making trend analysis less reliable in isolation. Importance of knowing trend analysis. Understanding trend analysis is crucial for investors and managers. It helps investors assess a company's potential by looking at its past performance and predicting future prospects. For managers, it aids in identifying areas of improvement and formulating strategies to ensure sustainable growth. Additionally, trend analysis provides insights into a company's resilience to changes in the market or internal factors. Overall, knowing trend analysis empowers individuals to make well-informed financial decisions and strategic choices for a company's success. Definition of trend analysis. Trend analysis involves collecting information and identifying patterns or trends in a specific metric over time. This is often done by comparing historical data using tables or charts. Purpose of trend analysis. The main purpose of trend analysis is to make predictions or informed decisions about future events based on historical patterns. It helps in understanding how a company's performance has changed over time. Finance and trend analysis. Trend analysis is used in finance to evaluate companies and their performance. One method is through fundamental analysis, which involves analyzing historical financial statements and using ratio analysis. Financial ratios. Financial ratios are key indicators used in trend analysis. They are calculated from financial statements and help in comparing a company's performance with its peers or over time. Limitations of financial ratios. Trend analysis using financial ratios can be complicated due to changes in companies and accounting practices over time. For instance, a company may change its business model or accounting methods, affecting the comparability of ratios. Sentiment and technical analysis. In finance, technical analysis involves studying past market data, like stock prices and volume, to predict future price movements. This is different from sentiment based measures used in technical analysis. Creditors and managers' perspective. Creditors and company managers also use trend analysis to assess financial health. They may focus on ratios related to liquidity, profitability, and other important financial aspects. Adjustments in ratio analysis. To ensure accuracy in trend analysis, analysts often make adjustments to ratios when companies undergo significant changes. This may involve segregating data related to inconsistent business segments or separating recurring and non recurring items. Graphical representation of trends. Graphs are commonly used to visually depict trends over time. They allow for easier identification of patterns and trends in the data. Forecasting with trend analysis. Trend analysis is useful for making forecasts based on historical data. By identifying trends, analysts can make educated predictions about future events or conditions. Demand and popularity trends. Trend analysis is not limited to financial data. It can also be used to study demand and popularity trends for specific subjects or products over time. Reliability and uncertainty. While trend analysis can provide valuable insights, it's essential to recognize that it is not a foolproof method for predicting the future. Economic, market, and other external factors can influence outcomes, introducing uncertainty into forecasts. By understanding these key points, you will have a solid foundation for comprehending the concept of trend analysis and its relevance in the field of finance and other areas where historical data is analyzed to make informed decisions about the future. Profitability ratios are financial metrics that help assess how well a business is making money compared to its costs, revenue, assets, and equity. They give us insights into a company's financial performance over time and are widely used in financial analysis. These ratios can tell us if a company is efficiently generating profits and creating value for its shareholders. There are two types of profitability ratios: margin ratios and return ratios. Margin ratios focus on how efficiently a company turns sales into profit. They include gross margin, operating margin, pre-tax margin, net profit margin, and cash flow margin. Higher margin ratios are generally better as they indicate success in converting revenue into profit. Return ratios, on the other hand, show how well a company generates returns and creates wealth for its shareholders. The main return ratios are return on assets, ROE, return on equity, ROE, and return on invested capital, ROIC. These ratios measure the company's ability to make profits relative to its assets or equity. Investors can use profitability ratios, along with other research, to decide if a company is a good investment. Comparing a company's profitability ratios to those of similar companies, its own past performance, or industry averages helps to assess its financial health. The most important profitability ratios are gross profit margin, operating margin, and net profit margin. These ratios show how much profit a company is making after accounting for various expenses. Profitability ratios are significant because they provide valuable information about a company's ability to make profits and how well it manages investments to generate returns for shareholders. The two commonly used measurements of business profitability are net profit margin and gross profit margin. Net profit margin measures the profit a company gets from total revenue after all expenses, while gross profit margin indicates profit above the cost of goods sold. In summary, profitability ratios are essential tools for understanding a company's financial health and performance. They show how efficiently a company is making money, and higher ratios are generally considered favorable. By comparing these ratios over time, or with other companies, investors and analysts can make informed decisions about a company's financial prospects and potential as an investment. Simple explanation: profitability ratios are like scorecards that tell us how well a company is doing financially. They show if the company is making enough money compared to its costs and investments. Higher ratios mean the company is doing better at turning sales into profit. 2. Mental model, garden analogy. Think of a company as a garden and profitability ratios as tools to measure the health of the garden. The flowers represent sales, and the fruits represent profits. The better the gardeners, company's management, take care of the garden company, the more fruits they can harvest, profits. 3. Quick example exercise. Q1. What does a higher profitability ratio indicate? A higher profitability ratio indicates that the company is making more profit compared to its costs, which is a good sign of financial health. T2, name three types of profitability ratios. Three types of profitability ratios are gross margin, net profit margin, and return on equity, ROE. Q3, how can investors use profitability ratios? Investors can use profitability ratios to determine if a company is a good investment. Higher ratios suggest that the company is efficient in making profits. Advantages and disadvantages. Advantages. Profitability ratios give a clear picture of how well a company is performing financially. They help investors make informed decisions about whether to invest in a company or not. Comparing ratios over time or with other companies helps identify trends and strengths. Disadvantages. Profitability ratios may not consider external factors that can impact a company's performance. They focus on the past and may not fully predict future outcomes. Relying solely on ratios without considering the bigger picture can lead to biased judgments. Why is this important to know? Understanding profitability ratios is crucial because they give us insights into a company's financial health and management efficiency. They help investors and analysts make informed decisions about investing in a company. Moreover, companies can use these ratios to identify areas where they need to improve and make better financial decisions for sustainable growth. By using simple terms, analogies, and exercises, you can grasp the concept of profitability ratios more easily and see how they play a crucial role in financial analysis and decision-making. Profitability ratios are financial metrics that tell us how well a company makes money compared to its costs and investments. They help assess a company's financial health. Purpose of profitability ratios. These ratios show how efficiently a company generates profit and value for its shareholders over time. Comparison tools. Profitability ratios are best used for comparisons rather than looking at them in isolation. Comparing with industry averages or other companies gives better insights. Types of profitability ratios. There are two main types of ratios: margin ratios and return ratios. Margin ratios. These ratios measure how well a company turns its sales into profit. Examples include gross margin, operating margin, pre-tax margin, and net profit margin. Gross margin. It compares sales revenue to the costs directly related to the products sold. A higher gross margin can mean a competitive advantage. Operating margin. It shows the percentage of sales left after considering both the cost of goods sold and normal operating expenses. Higher operating margin indicates better efficiency. Net profit margin. This ratio reveals how much profit a company earns after all expenses, including taxes. A higher net profit margin is usually better. Return ratios. These ratios evaluate how well a company's investments generate returns for its shareholders. Examples include return on assets, ROE, return on equity, ROE, and return on invested capital, ROIC, ROO. It shows how effective a company is at using its assets to generate sales and profits. Higher ROA indicates better asset utilization. RORO. This ratio measures the return earned on the shareholders' investments. A higher ROE can indicate a company is financially healthy and efficient. Importance of profitability ratios. These ratios are significant because they help investors and managers understand a company's financial performance and make better decisions for growth and investment. Remember, profitability ratios are like scorecards that give a glimpse of how well a company is doing financially. They are essential tools for understanding a company's financial health and comparing its performance with others in the industry. By using these key points, you can gain a better understanding of profitability ratios and their significance in financial analysis. Operating margin: how much profit a company makes. The operating margin is a ratio that shows how much profit a company earns for every dollar it makes in revenue. It helps us understand how well the company is doing financially. The formula is operating margin equals operating income slash revenue. What it tells us: the operating margin tells us how much money a company actually makes from its operations. It's important because earning revenue alone doesn't mean the company is making a profit. We need to see how much profit they're left with after deducting operating expenses. For example, if a company has an operating margin of zero point 0.5, it means they make $0.50 in profit for every dollar of revenue they earn. Limitations: while the operating margin is useful, it's not perfect. It doesn't consider all expenses like taxes and interest. Also, it doesn't include investments needed for future profitability. So it's just one tool to understand a company's financial health, not the whole picture. In short, the operating margin helps us see how much profit a company is making from its regular business activities, but we need to look at other factors too to get a complete picture of its financial well-being. Explanation in simple terms: imagine you have a lemonade stand. You want to know how much profit you're making from selling lemonades. The operating margin is like a special ratio that tells you how much money you make for every dollar you earn from selling lemonades. It's an important number because it shows how well your business is doing financially. But remember, it only looks at your profit from selling lemonades and doesn't consider other things like the money you spend on ingredients or taxes. 2. Mental model: the lemonade stand ratio. Think of the operating margin as a ratio that helps you understand your lemonade stand's profit. Just like you divide the money you make from selling lemonades by the total revenue, money earned from sales, to find out how much profit you make for every dollar of sales. Free. Example exercise: you have a lemonade stand and you sold lemonades for $100. Your total expenses, like cups, lemons, and sugar, for making the lemonades are $40. What is your operating margin? Answer: operating margin equals revenue. Operating expenses slash revenue operating margin equals $100, $40 slash $100 equals $60 slash $100 equals 0.6 or 60%. Your operating margin is 60%, which means you make a profit of 60 cents for every dollar you earn from selling lemonades. 4. Advantages and disadvantages. Advantages: the operating margin helps you see how much profit you make from your main business activities, like selling lemonades. It's a good way to compare your lemonade stand's profitability over time or with other lemonade stands. Disadvantages: the operating margin doesn't include all expenses like taxes and interest, so it's not a complete picture of your overall financial health. It doesn't consider investments needed for future profits, like buying a new lemon squeezer, which is important for long-term success. Why it's important to know: the operating margin is crucial because it shows how well your lemonade stand is doing in making a profit. It helps you understand if you're earning enough money from your lemonade sales to cover your expenses and if your business is financially healthy. However, remember that it's just one piece of the puzzle, and you should consider other factors too when making business decisions. What is operating margin? Operating margin is a ratio that tells us how much profit a company makes for each dollar it earns from selling its products or services. Formula: operating margin equals operating income slash revenue. Profitability measure: it shows how well a company is doing in making profits from its main business activities. Focus on operations: it looks at the profit made from the core operations of the company, like producing and selling goods or providing services. Key indicator: a higher operating margin means the company is more efficient at turning revenue into profit. Example: an operating margin of 0.5 means the company earns $0.50 profit for every $1 of revenue. Measuring success: It helps compare profitability over time and with other companies in the same industry. Imperfect measurement. It doesn't include all expenses like interest and taxes, so it's not the whole picture of a company's financial health. Operating income. It's the profit left after covering operating expenses like production costs and